Okay, so there's this theory that's been making some serious waves online. It tells a wild story about a supposed crisis brewing in the global silver market. We're going to deconstruct it, piece by piece, and look at how the source builds its case.
So the whole thing kicks off with this really dramatic scene. The source doesn't start in London or New York, the usual financial hubs. Nope. It starts in Zacatecas, Mexico, right in the heart of silver mining country. It immediately sets this tone of secrecy and, well, urgency.
And that leads us right to the big question at the heart of this whole theory. Why on earth would a private jet carrying senior executives from Samsung, of all companies, suddenly show up there?
Right, so this slide really lays out just how weird this whole situation is according to the source. I mean, look, Samsung is a massive user of silver, no doubt about it. But they have a system for this, right? They buy from the big, established markets like the London bullion market. So the theory goes, for them to fly executives directly to a mine on a Sunday, that's a massive red flag. It's a total break from how things are supposed to work.
And that's the million-dollar question, isn't it? What could possibly be happening that would make a company like Samsung just throw out the rulebook and go straight to the source? Well, the theory suggests the real answer isn't in Mexico at all. It's something that supposedly happened in London just hours before that jet even took off.
So, the next piece of the puzzle, according to this theory, is the event that supposedly set everything in motion. There was this technical problem on the London silver market, but the big question the narrative asks is, was it really just a glitch?
And this is where you see two totally different stories emerge. The official line was, hey, it's just a computer bug, a temporary halt, nothing to see here. But the source we're looking at makes a much, much bigger claim. It says it wasn't a glitch at all. It was a failure to deliver the physical metal. In market terms, that's a default.
And what the theory really hammers home is just how fast all of this went down. It's like dominoes falling. On Friday, you have the alleged default in London. By Sunday morning, Samsung's jet is already on the ground in Mexico. And then, just hours after that, the theory claims another huge domino falls. And this brings us to the next massive piece of the theory. A huge and supposedly secret supply shock coming directly from the world's biggest silver refiners.
Now, the theory claims this wasn't some public press release. Far from it. This was a so-called silent directive from China's central bank. They call it window guidance, which basically means a quiet order passed directly to the Shanghai Gold Exchange, totally off the public radar.
And the impact of this move, if it's true, well, it's just staggering. China is the biggest refiner on the planet, and this theory suggests that with one quiet phone call, they essentially vaporized 40% of the world's entire exportable supply of refined silver, just gone from the market overnight.
So why would China do this? The source is pretty clear. This wasn't about money. It was a strategic move, a resource war. It argues that China is hoarding silver to fuel its own massive ambitions. We're talking huge solar power projects, next-gen EV batteries, AI chips, and even its own defense industry. They need the actual physical metal, and they're making sure they have it.
So you've got this alleged default in London, right? Then a massive supply shock from China. And what happens next, according to this theory, is that the whole global market for silver just fractures. It doesn't just have one price anymore. Suddenly, it has three.
First up, you've got what the source calls the fantasy price. This is the official number you see on the screen, the price for a paper futures contract on an exchange like COMEX.
But then you've got the price in Shanghai. The theory claims that while the paper price was sitting at $63.80, the actual price for physical silver in China was the equivalent of $74.50. That's a huge premium, supposedly reflecting this new reality of scarcity. And finally, at the very top, you have the emergency price. This is the price the theory says Samsung was willing to pay, $78 an ounce, to get their hands on physical silver right there at the mine in Mexico, bypassing the whole broken system.
So this table just lays it all out, plain and simple. The argument here is that a complete disconnect is formed. You have the fantasy paper price, the reality price for physical metal in a key market, and the emergency price that industrial giants are supposedly paying just to keep their factories from shutting down.
Okay, so what does a market like this actually do? What are the consequences? Well, the theory then zooms in on the big financial institutions, the bullion banks that trade all those paper contracts.
And according to the theory, you started seeing the stress show up in some pretty interesting places. This quote allegedly came from a major wholesaler in Dubai's Great Market who basically told his entire network to just stop selling. Even with a high bid of $69 on the table, there was, quote, no offer.
So, no offer. What does that actually mean? It's a critical piece of trader talk. It's when sellers just pull back completely, they go on strike. It means they've lost all faith in the official price and believe it's totally fake. They'd rather just hold on to the physical thing than trade it for what they see as worthless paper money.
And this is where the theory sets up what it calls a mathematical impossibility for the bullion banks. Here's the trap. They were allegedly holding these massive short positions, basically betting that the price of silver would go down. But now the price is screaming higher and the physical supply has vanished. They have to buy silver to cover their bets, but the theory asks a simple question. In a no-offer market, who's going to sell it to them?
And all of this, every piece we've talked about, it all builds to the theory's really dramatic conclusion. It's a concept they borrow from sci-fi to describe what they see as a totally new economic reality.
The unobtainium phase. It sounds like something out of a movie, right? But the source uses it to describe the moment when the link between money and real essential stuff just snaps. It's a world where it doesn't matter how much cash you have because the critical resources you need simply aren't for sale at any price. Having the thing itself becomes more important than having the money to buy it.
So when you boil it all down, the core argument here is that this wasn't just a temporary squeeze or some short-term market event. The narrative claims that what happened over that one weekend was a fundamental, permanent shift, a moment where the power moved from the people who trade paper to the people who hold the actual physical metal.
And so this whole theory ends right where it began, with a really provocative question. It pushes you to think past the daily market noise and ask something much more fundamental about the world we live in. What is money really worth if you can't use it to buy the things you absolutely need?